The purpose of this video is to introduce you to the corporate form of business. A corporation is a separate legal entity and is owned by investors, which are called stockholders or shareholders. There are several reasons that businesses choose to incorporate, but the primary reason is to limit the liability of the owners. If a sole proprietor runs up a substantial amount of business debt, the sole proprietor can be held personally liable for that debt. All of his or her personal assets are at stake. If a corporation runs up a substantial amount of debt, the owners are not personally liable. The most that owners of a corporation can lose is their investment in that corporation, not their personal assets. There are some disadvantages to incorporating as well. The biggest disadvantage is double taxation. Corporate earnings are taxable, so a corporation must pay income tax on its net income. Then, when these already taxed earnings are given out to the owners in the form of dividends, they are taxed again. So the income of a corporation is taxed twice. Once a corporation receives its charter from the state that allows it to do business, the stockholders elect a board of directors who are then responsible for appointing the officers in the corporation. The officers run the day-to-day operations of the corporation and supervise the employees. Now let's compare what we already know about equity in a sole proprietorship to that of equity in a corporation. A sole proprietorship only has two equity accounts: the owner's capital and the owner's drawing. Remember, the owner's investment is entered into the owner's capital along with the company's net income and any net losses. When an owner takes business assets out of the business for his personal use, we would debit the drawing account. Now let's take a look at a corporation's capital. In a corporation, there are 4 equity accounts. Instead of placing everything in capital, we separate the capital by what was paid in, what was actually earned by the corporation, and what was paid out to owners. All owner investments, which are sales of stock, go into the capital stock and the additional paid in capital account. All earnings of the corporation are entered into the retained earnings account, and all payments to owners or shareholders are entered down here into the dividends account. Keep in mind that capital stock, additional paid in capital, and retained earnings all have normal credit balances because they are capital accounts. The dividends account is like the drawing account. It has a normal debit balance. Capital stock is the shares of ownership in a corporation that are purchased by investors. There are 4 terms related to stock that you should be familiar with. The first is authorized stock. This is the total number of shares the corporate charter authorized the corporation to issue when it was first formed. Issued stock is stock that has actually been sold to investors and issued. Treasury stock is stock that has been sold to investors and then bought back by the corporation. And outstanding stock is the number of shares in the hands of stockholders. So if we take the amount of issued stock and subtract out what was purchased back by the corporation, which is the treasury stock, we'll end up with the outstanding stock. There are 2 values applied to our shares of stock. The first is called the par value. The par value is the amount that appears on the stock certificate when the corporation was first organized. The second is the market value. The market value is the amount that the stock can be sold at on the open market. It is the amount that investors are willing to pay for the share of stock. There are generally two types of stock that are sold to shareholders. The first is common stock. If a corporation has only one type of stock, and many do, it is common stock. Each share of common stock comes with the right to vote at shareholders' meetings. The second type of stock is preferred stock. Not all corporations issue preferred stock, but when they do, preferred stockholders receive dividends before common. After all preferred stockholders receive their dividends, whatever is left goes to the common stockholders. Preferred stock does not come with the right to vote. Let's look at the journal entry for the sale of stock. A corporation sells stock to investors in order to raise capital for the corporation. Upon purchasing the stock, the investors become owners of the corporation. So let's look at our example. Link Corporation issues 10,000 shares of $5 par common stock at par for $50,000 cash. So first of all, we're going to enter a debit to cash for the $50,000 that the corporation received upon selling the stock. Then we're going to enter the sale of the common stock. That's a credit to common stock for the par value. So 10,000 shares were sold at $5 par common stock. So we credit common stock for $50,000. What if the stock had been issued for $60,000 cash? Once again, we would debit cash for the $60,000 received for the stock. Then we're going to credit common stock for the par value of the stock. Common stock is always credited for the par value only. So the difference between the amount of cash received and the par value of the stock is $10,000, and that $10,000 gets credited to an account called Paid in Capital in Excess of Par Common Stock. It's just one long account name. So what happens when we issue stock for something other than cash? Let's look at this example. Link Corp issues 5,000 shares of $5 par common stock for a truck. It's hard to determine the market value of the stock, but the truck has a known market value of $30,000. So the first thing we'll do is debit truck for $30,000. The asset will be valued at either the value of the truck or the value of the stock, whichever one is better known. In this case, it's the truck. So we're going to debit truck for $30,000. Common stock, as always, gets credited for par. So 5,000 shares at $5 par is $25,000. The difference is going to the account with the long account name, Paid in Capital in Excess of Par Common Stock. So the credit for $5,000. Next, let's look at stock subscriptions. Stock subscriptions are an agreement in which a buyer contracts to buy shares of stock from a corporation at a specific price. It's usually large numbers of shares of stock. Stock subscriptions are really similar to a layaway plan. So the subscriber sees some stock that he likes at a good price, so He agrees to pay the amount in full on a specified date or in installments. The stock is not issued until the subscriber makes the full payment on the stock, just like a layaway. When you pay off your layaway, you get your merchandise. So when the subscriber pays off his stock, he'll receive his stock. So let's look at an example. And it's very similar to a stock issue. Link Corp received subscriptions for 10,000 shares of its $5 par common stock for $60,000. So we are going to issue these subscriptions, and it looks a lot like an actual stock issue, except we're not receiving any cash. We're receiving a promise to pay. So instead of debiting cash here, we're going to debit stock subscriptions receivable for the amount promised, which was $60,000. Then we're going to credit common stock subscribed. Usually with the stock issue, we will credit common stock, but we're not issuing the stock yet, so we're going to credit common stock subscribed at the stock's par value. So 10,000 shares at $5 par is $50,000. Then the paid-in capital in excess of par common stock for the amount over par, which is $10,000. Okay, then we have a partial payment that's received. So the subscriber has made a payment to the corporation, a partial payment for the stock. So the corporation received $40,000 in payment for the stock. So we will debit cash for $40,000 and then credit stock subscriptions receivable for $40,000. What this does is it brings down the balance of the stock subscriptions receivable. It was $60. We're going to credit it for $40. So now we know that the subscriber owes $20,000 more for the stock. Okay, now here's where the subscriber is making his final payment of $20,000. So we're going to debit cash for $20,000 and credit stock subscriptions receivable for $20,000. So this completely takes the stock subscriptions receivable off the books. So he is paid in full so we can issue the stock. So if we're going to issue the stock, we're going to credit common stock at par value here, and we're going to remove the common stock subscribed with the debit. Remember, originally we had put common stock subscribed on as a credit, and then when we actually issue the stock, we will remove the common stock subscribed with the debit and put the common stock in its place with the credit. Next, let's look at the journal entry for treasury stock. When a company buys back its own stock from investors, it's called treasury stock. When treasury stock is purchased, the account treasury stock is debited for the amount paid. Keep in mind it's for the amount paid, not the par value. We do not use the par value when dealing with treasury stock. The treasury stock account is a contra stockholders equity, which means it has a normal debit balance. So let's take a look at our example. We have ABC Corporation that purchases 3,000 shares of its $5 par common stock for $6 per share, a total of $18,000. When journalizing treasury stock, we never use the par value, so don't be tempted to use that like we do in a regular stock transaction. What we will use in the case of treasury stock is the cost of the treasury stock. So this treasury stock costs $6 per share. So 6 times 3 is 18,000. So we will debit common treasury stock for 18,000 and then credit cash for the $18,000, which is what the corporation paid to purchase back its stock. Okay, now in this transaction it says it's the ABC Corp sells 2,000 of the 3,000 Treasury shares that it had purchased before for $7 per share, a total of $14,000. So ABC sold its Treasury shares back to investors and received cash of $14,000. So we no longer have the common Treasury shares, so we're going to credit common Treasury stock for $12,000, which was the $6 per share from before times the 2,000 shares that we sold. So the Treasury stock, when you sell it, comes off at cost. The difference between the sale price and the cost of the stock goes into an account called paid in capital from sale of Treasury stock. Okay, once again, ABC has sold some Treasury stock. They sold the remaining 1,000 shares for $5.50. Remember, they had originally purchased 3,000. They first sold back 2,000, so 1,000 shares of Treasury stock remains. So we're selling those back to investors for $5,500. So the corporation debits cash for $5,500. The Treasury stock now will be credited for the cost, just like we did in the previous transaction. 1,000 Treasury shares times the $6 cost from before. So we remove the remainder of the Treasury stock for 1,000 times $6, or $6,000. The difference between the sale price, once again, and the cost of the Treasury stock, this time it has to be debited, but it goes to the paid in capital from sale of Treasury stock, just like in the previous transaction. Last, we're going to look at the Stockholders Equity section of the balance sheet. Remember, the balance sheet lists assets, liabilities, and owner's equity. For a corporation, the equity section is called Stockholders Equity. In this section, you will see the paid-in capital accounts. First, preferred stock is listed along with its description. It said the preferred stock is 7%, $10 par, 20,000 shares authorized, and 14,000 shares issued. Since we've issued 14,000 shares at its $10 par, the value of the preferred stock is $140,000. Then preferred stock is followed by preferred stock subscribed. That's 6,000 shares. So 6,000 shares at a $10 par value is $60,000. Then the balance in the paid-in capital in excess of par preferred is listed. The three balances are totaled to get the total paid-in capital for preferred stock. Next, common stock is listed with its description. This is a no-par stock with 40,000 shares authorized, 16,300 shares issued, and it has a value of $163,000. Common stock subscribed, there are 4,000 shares with a value of $40,000. There is no paid-in capital in excess of par for common, so there's none listed. We'll add up the two balances under common stock, so the total paid-in capital for common is $203,000. Last is the paid-in capital from the sale of Treasury stock. You may or may not have a balance in that account, but if you do, include it right underneath the common stock. When you add the three paid-in capital totals together, you get total paid-in capital of $459,600. Next, the retained earnings balance is entered to get a total of $519,600. Now this company has treasury stock on the books at $22,000. Remember, treasury stock is a contra stockholders equity account, so the value of the treasury stock is deducted from the total stockholders equity to get a grand total of $497,600.